Good morning, everyone. Welcome to this update for the 17th of April for global markets. And during the last week, the uptrends that we've seen over the last 6 weeks or so continued. Markets are pretty stable at the moment and really no disruption at all. So it's been a bit of a surprising period of calmness and stability. But look, I fully don't expect that to last. That's for sure. So let's get on and have a look at what happened last week. American stocks, the S&P index was higher by 38 points on the week, which was a good performance. Technically, the market has a bullish bias, and certainly sentiment is positive, and that's what's pushing the market higher, even though there's a very good case could be argued on fundamentals and value that the market should be lower. It is going up, so it just is what it is. The Dow Jones has broken out. We've seen the small caps moving higher. So there really aren't any areas of weakness. Energy has done really well. Healthcare started to bounce back. So all the sectors that have been struggling are certainly looking a heck of a lot better than they were a couple of weeks ago. Also, too, the rally is being supported by an indicator which is called the cumulative advanced decline line, which is basically showing the breadth of the market. It's showing how many stocks are advancing as opposed to how many stocks are declining. And that ratio is now at a new 52-week high. So clearly, there are a lot more stocks that are advancing than there are declining, and that's pretty good. Now, having said that, it still doesn't feel right to me that we should only be 2% below the all-time highs. Of course, in Australia, that's a very, very different story. We're a long way below the nearly 7,000 point level that we reached in 2007. But the American market is back to within only 2% of all-time highs, despite what central banks are doing, and despite all the issues out there with the oil price and with negative interest rates. But look, we just have to put away our normal, predisposition about what we think should happen and just accept what is. Now, April is generally a strong month. Then it's followed by a traditionally weaker period from May through to September. That doesn't mean it will be the same this year, because it doesn't always work out that way. But look, I'd be surprised if we didn't at least get some significant volatility during the next 4 to 6 months. Aussie stocks and our currency, we finished at 77 on Saturday morning, and our index rocketed higher by 220 points for the week, so a big gain in the Australian market. And that was largely led by a 10% rise in the major miners, and also to a lesser degree Woodside. So a much, much more positive week in the Australian market. However, having said that, most stocks are not trending on a medium to longer term view. All that's happening is stocks are bouncing back from the selling. So we're still nowhere near the highs that we were even a couple of years ago. And even local gold stocks, now as I'll cover off shortly, globally gold stocks are doing far better. They're probably about the only sector that really has got a strong momentum behind it. But even the local Australian gold stocks are not doing as well as the American gold stocks, which I find interesting. I don't know whether that's just a bit of a short-term phenomenon or not, but that's the way that it is at the moment. So let's jump in and have a look at some charts. And we'll start first of all with the S&P, and you can see these are the all-time highs up at 2130. There was a succession of lower highs. That's now been broken. We've now broken above that downtrending resistance line. We went above it. We came back. We retested it. We went back to the top of that little mini range there, and then we broke out above it on Wednesday in pretty emphatic fashion, as you can see. So look, who's to say that this market doesn't need to move very much further? It's only another 50 points to the all-time highs. and the way this market is going, if there were some decent earnings reports coming out, then I think it's not beyond the realms of possibility that the American market could move to the all-time highs in the next couple of weeks during earnings season. I think earnings season really is important because the market has been factoring in some pretty solid earnings growth over the next couple of years. They're looking for American companies to grow their earnings by between 10 and 20% a year. And given the way the American economy is and all the various headwinds that can happen with currencies and the like, I'm just finding 10 to 20% growth expectations is just too rich for me. So I think American companies are going to tend to disappoint in coming years. But at the moment, they're playing this game of lowering expectations into earnings season and then beating them. And then the market cheers and the prices go up. And this goes round and round, and each quarter the stocks, because the long-term earnings aren't really there, stocks are just getting that bit more expensive every quarter. Every time they play this game around earnings season, the average valuations are rising. So, I don't find it a particularly comforting market from a fundamental point of view, but certainly from a technical point of view, there's no question of the strength. Now, I marked down here future support. I did that some weeks ago, and I've left it there on purpose, even though I now should raise that whole Fibonacci scale up a little bit higher. That is where I would have expected the market to have corrected to. That level is now up at around 1980, but you can see the market is still 100 points above that. So if there were to be even a mild correction, we're looking at 100 points. So I think eventually we will see a correction in the market, but when it happens, it's probably going to be fairly sharp. That's the good news and the bad news. Now, the US dollar has certainly been helping because the US dollar has weakened off from around 100. We're now back to 95. You can see this clearly in short-term downtrend. We're around about key support at the moment. And the US dollar is really important for a number of reasons. It's obviously has a bearing on the revenues and earnings of a lot of American companies. It also has a significant benefit for commodity prices and for emerging market economies and stock markets. So that's a dynamic that is certainly playing out. So there's quite a bit of vested interest in the US dollar being a little bit weaker. Longer term, it's pretty hard to see with what they're doing in Europe and Japan and even in China that the American market or the American currency will stay down at this level. I do expect to see it work its way back towards 100 over time, but look, who knows? Now, just turning quickly to the Australian market. So there's the Aussie market. We've had this long-term downtrend, or this channel that started about a year ago. We had a little preliminary break in March. We descended back into the range, and now we're breaking out again, and just shows you how robust last week was. 4 really big up days to dominate the week. So quite impressive in the Australian market. Now, turning to precious metals. Gold was down a little bit for the week, but the really good news is that gold stocks were positive. They were comfortably positive. We had a bit of a dip during the middle of the week in gold stocks, but look, gee, it was really mild, and they took off again on Friday night. And as you've heard me say many, many times, gold stocks will lead the sector and lead the price of gold, both in the upwards and the downwards direction. So the fact that gold was down by $5 for the week, yet stocks went up, continues to be a very, very good indicator for where this sector is going. Now, there certainly is, I won't bore you to tears with all the detail, but certainly there's a lot of mounting evidence that the market rigging, which was in the shadows for probably most of the time up until around 2011, 2012, then it became quite overt, and the major players just stopped hiding the market manipulation. But now there's evidence that that market rigging, so the setting of prices, the gold price in the futures market, there's evidence that that's being curtailed. And that means that physical trading in metals, so this is not the futures market, this is not people playing games with dumping massive paper contracts on the market all in one go with the explicit intent of disrupting the market and forcing it lower. This means that the physical trading in metals, so the buying and selling of the actual physical underlying metal, is likely to have a greater impact on determining the price of gold than it has over the last decade and a half. And that's got to be a good thing. Now, also too, silver is just starting to confirm the move in gold. Silver has lagged so far. It hadn't really done very much. Gold had broken out. But silver hadn't done anything, but it's starting to move now. So that provides confirmation for the move in gold, because silver will at some stage outperform gold substantially. And that's just the way that bull markets develop. So I find the move in silver just yet one more confirmation of what's happening in the gold sector. Now I just want to show you a couple of quick charts just to give you an idea of how these bull markets do unfold, perhaps as to what we could look forward to. Now, this is the period from 2005 to 2011. Silver is in the blue line, and the price of gold is in the red line, and that's the scale on the right-hand side is in percentages. So you can see that silver tracked along with gold for most of that period until we got to 2010. There was a bit of a dip during the GFC where it went below, but then once silver starts to break out and outperform gold, you can see that it outperforms gold by a large amount, a very big amount. Let's look now at the period from 2011 to 2016. So you can see that silver certainly underperformed gold during that bear market. And again, that's exactly what you would expect. And that gap was pretty wide. In fact, it's really at its widest just very recently at the end of last year and into the early part of this year. And you can see that the red line, gold, had jumped from being around 44% down to about 32% down. So it actually improved by about 12 percentage points. But with silver, there wasn't nearly the same degree of improvement. It was only about 5%. But if we just zero in on that a little bit closer, you can see the last week or so. You can see how silver, which is the bottom line, has really caught up with gold and has basically just slightly gone ahead of the gold line. So this is a very, very recent situation, and it's good confirmation for what's happening in gold. I'll just have a look at the gold charts while I'm here. So first of all, we'll look at gold on a weekly chart. So you can see on that bigger picture level that we've had quite a nice rebound. We've broken above that downtrending line that had been in place since around September 2013, series of declining highs. We then got one final capitulation, and then the market has moved back very strongly. Now, we've had a consolidation here now for about 10 weeks, which consolidates these two very large weeks of gains, which occurred in February of this year. So that's a promising pattern. We really haven't had much of a pullback. It's just gone straight up, formed it's a little triangle forming there, and that normally is a continuation pattern and should resolve to the upside. Now, there's some pretty big numbers being thrown around in terms of target for gold price. I've seen $5,000 an ounce, $10,000 an ounce. I have no idea whether that's valid or not. I think they're numbers that are just being tossed out there by people. I think just completely dismiss those numbers for the time being. The important thing is that gold stocks, and I've covered this a number of times, gold stocks, to get back to their normal relationship with gold, would have to treble in price without gold moving just to get back to the normal long range ratios. That's how far gold stocks had been smashed down. So I'm not really hanging out for gold, the price of gold, to do anything much, to be honest, other than just stay around this level. If it goes higher, that's a fantastic bonus, but it doesn't need to. Looking at the daily chart, just gives us a little bit more detail. You can see it's really been a big period of consolidation now since the 10th of February, so 2 months. Silver starting to look better. You can see that the price of silver had been below that moving average, which is a 150-day moving average. It had been below it almost all the time. That moving average is now basically turned. It's turned up very slightly, so it's only early days. But you can see now the price is consistently above. And we are forming higher highs and higher lows. So there's little doubt in my mind that the character of the silver market has changed as well. Whether it's ready to actually go into a bull market, I don't know. Time will tell. But I can tell you that the character of the silver market, as the gold market has changed, and you've got to take note of that. And silver and gold stocks are basically leading the way. Now, there are some silver and gold stocks that are not good businesses to own, and there are some that are great businesses to own, and you need to know the difference. Don't think that everything is just going to rocket upwards from here because the sector's doing well. That won't be the case. So copper rose just one other thing I wanted to cover. Let's look at the gold stocks. So let's look at the HUI index. So clearly, there's no question here with the blue moving average, the 50-day crossing over the 200, and it's rapidly rising. We didn't get a pullback. We just had an upwards consolidation, a little flag there, and then we broke out from that. It broke above some nominal resistance. Had a couple of days down, but looked pretty mild, and then turned around again on Friday night. So very, very positive signs from the gold sector. Copper rose to $2.18, but look, they're still under a bit of pressure to my way of thinking. Nothing much has really changed there. Crude oil was higher to just over $40, but it did ease back at the end of the week. And to the best of my knowledge, there's been no announcements from the very, very important Doha meeting this weekend, where they're hoping for some sort of production freeze and cutback by OPEC and others. I think the hope for that are fading because I think Iran said they wouldn't be turning up for the meeting, and it's pretty hard to see how countries like Russia and Saudi Arabia are going to come to agreement because they're all in trouble. I read yesterday that the revenues for OPEC nations in 2014 was about $1 trillion a year, and it's now $500 billion. So their revenues have been cut in half, and that's causing enormous issues with their budgets and all sorts of things. So for them to say, well, we're going to cut production back even further, I just don't think it's going to happen. Ultimately, they're going to have to make some very, very tough decisions. And I think that's going to be one of the disruptive influences on the market. If the outcome of this weekend's Doha talks is not positive, I think you'll see some fairly disruptive markets next week because there's been this strong correlation between the oil price and the price of the banks, and then hence the price of the general stock market. So I'm looking for the possibility of plenty of volatility built around oil. There's the spot copper chart. Not a lot of change in the week, but you can see certainly under pressure over the last month or so. So to wrap things up, looking at the overall strategic approach, a US correction from May through the middle of the year is still definitely a possibility. But you must wait for it. Trade what you see. I read so many people that are out there trying to make a name for themselves by calling a top in the market or calling a bull market. You've just got to stop predicting because no one really knows. Just wait for it and let the market show you what it's doing and go with what the market is at the moment. And don't try and do anything fancy. Precious metal stocks are really the big story. The signs remain highly positive, but you need to understand this is a highly volatile sector. If you look back in the period from the end of 2008 through to 2011, yes, the gains from point A to point B were substantial. They were hundreds and hundreds of percent. But if you look at the detail of how much prices fluctuated around, it's going to be very scary for the uninitiated. So, don't just embrace this and think we've got this wonderful bull market in gold and you're going to make lots of money. Yes, there is the potential to make very, very outstanding returns, but there's definitely a way that you need to do it. You've got to have a predetermined plan. It is absolutely critical. And if you think that you can navigate the next few years of a gold bull market without having pre-thought through all the various potential movements in the market and what your response to it would be, then you're kidding yourself. It's an absolutely critical thing to do. And if you don't know how to do it, and a lot of people don't because they just don't have enough experience in the market, then that's the sort of thing that I help members with. So, you don't need to be on your own in this process. Markets in general are going to be far from plain sailing, but as I've been saying recently, any turmoil in the market is an opportunity to make money. So don't be scared off by it. The key is to be prepared. And I can't overstress the importance of looking at things in terms of reward for risk. If you want no risk, then don't be in the stock market at all. Just be in fixed interest, and you'll be guaranteed a low return. But if you want a better return than fixed interest, then the bottom line is you have to take some risk. But it's a matter of being adequately rewarded for that risk, whether that risk is a little bit extra or a lot extra. If you're taking a lot of extra risk, then make sure that you are getting potentially a lot of extra reward for it. And there's plenty of opportunities out there to take a lot more risk for a lousy incremental return. So I do not agree with the concept that higher return equals higher risk. It's untrue in my view. You can take a lot of risk and get paid poorly for it, or you can get paid very well for it. I mean, just look at the junk bond sector for a start. You can, for a substantially higher risk, your potential reward is only a little bit above government bonds. Now, to me, that's the dumbest bet of the year. Yet so many people are taking it. So just be aware of what could unfold in the market. Think it through in advance, but don't fret about it. Get on with it because there's terrific opportunities. Look, I don't know, and no one else knows either, how prices are going to move in the future. So you want to just drop that idea that you can latch onto someone who's going to tell you how things are going to unfold. All you can do is work on the balance of probabilities, and that's all that I ever try to present to you. The only thing that I do feel comfortable with is the volatility that we're going to see, because there's so many negative triggers out there where normal markets have been distorted, they've been stretched, they've been manipulated by central banks to the absolute extreme in trying to defy the laws of economics. I mean, this is what central banks are trying to do. They're trying to stop the normal cycle of economics of boom followed by bust. And it's all going to end very, very badly, as I've been pointing out. I just don't know when. I intend to continue to work off what I see and not what I think I should see. And there's a really, really important distinction there. I'm following a large number of indicators across a lot of asset classes, stocks, currencies, bonds. I'm literally looking at dozens and dozens of different really important indicators. I know what the advanced warning signs look like, and I'm alert to them absolutely every day. So I'm not going to get caught short here. And I intend to bring those indicators to your attention quickly. That's the process of this weekly video, and now the new additional service that I launched through the week, where I'll be basically responding to unfolding events as they occur. But in the meantime, don't fret about what the market might do. Just get on with it. There are opportunities now that we have that are terrific. So just get on and take advantage of those. There's my contact details for non-members. As I've been at pains to explain for a long time now, volatility is great if you know how to work with it. They present terrific opportunities, but it also presents terrific dangers. And if you really don't feel that you've got your game plan sorted out, then I know I can help you enormously with that. So please feel free to get in touch with me. That's it for this week. Cheers.